Live from New York City this morning. Good morning, good morning. Your equity market session lows down by 0.5%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, President Biden facing escalating risk abroad. Congress confronting total dysfunction at home as bond yields are climbing to 17-year highs. We begin with the big issue, a single blast dividing the Middle East. An explosion at a hospital in Gaza upending President Biden's trip to Israel before setting a single foot on Air Force One.
Israel, as they respond to these attacks, seems to me that they have to continue to ensure that you have what you need to defend yourselves. And we're going to make sure that occurs, as you know. And we have to also bear in mind that Hamas does not represent all the Palestinian people. And it has brought them only suffering.
Hamas is blaming Israel. Israel is blaming the other side. The Israeli government insisting they have evidence. America wants a full investigation.
I was deeply saddened and outraged by the explosion at the hospital in Gaza yesterday. And based on what I've seen, it appears as though it was done by the other team, not you. But there's a lot of people out there not sure. Israel, as they respond to these attacks, it seems to me that they have to continue to ensure that you have what you need to defend yourselves. And we're going to make sure that occurs, as you know.
There has been an uncomfortable tension hanging over the region for more than a week, still seemingly on the brink of a bigger response. The president tasked with attempting to ensure it doesn't become a regional conflict. Team coverage begins right now with Bloomberg's Ollie Crook from Tel Aviv, Kelly Lyons from Washington, D.C. Good morning, Ollie.
Jonathan, you mentioned that tension that hangs over the region, and that's the tension that you go to bed with every day and you wake up and you don't know what you're going to find. And when you wake up to find an explosion in a hospital with, as they say, hundreds of people in there dead, then that is exactly the sort of thing that sends shudders no matter where you're sitting, whether it's in Israel, in Gaza, around the Middle East, or around the world. And that is the event that has really redefined Biden's trip here. He is here to provide support for Israel. He's here to provide deterrence, but he was also here for a key diplomatic position in part of this trip, and that was to speak with the leaders of Egypt, the West Bank, and also of Jordan. And that leg of the trip was canceled after these blasts, jumping to conclusions that this was Israel's fault. Israel, of course, has denied that it is their fault. They say that this is a misfired rocket within Gaza that came back on itself. And what we've had so far today is the president today in this building, in the basement here, meeting with Benjamin Netanyahu and the war cabinet. We expect to hear from the president a little bit later, but we'd like to see what he's going to say. What can he possibly bring from this trip? Maybe some progress on aid. At least we know it will not be a diplomatic progress with some of the Arab leaders.
Kaylee, a difficult trip for this president gets even harder.
Absolutely, John. The optics just getting more difficult as he was literally en route to try to make both legs of this trip. As we know, as Oliver just said, it now is only one. And that makes some of what the president is trying to accomplish with this visit much more difficult, specifically trying to deter others in the Middle East from potentially expanding this conflict even further, thinking of things like Iran or Hezbollah. And, of course, also meeting the attempt to meet with the president of Egypt, trying to secure humanitarian aid and corridors. As we just heard the president say, there is concern here about the life of innocent Palestinians as Israel is going after Hamas. On the other hand, what this trip does accomplish for President Biden is he is physically manifesting U.S. support for Israel, expressing that support for a key ally for the U.S., asking them what they need. And, of course, on the eve of his trip, John, Bloomberg also reported the president is getting ready to ask Congress for $100 billion in supplemental funding, not just for Israel, but also for Ukraine, Taiwan, even the border, trying to bundle a bunch together. But of course, the president can't deliver on a lot of those promises for funding until there is a functional House. And we don't have that just yet, John.
We don't have that at all. But there could be a big ask, Kaylee, for a lot of money for aid to Israel, to Ukraine, for the border. How big might that ask be?
It's going to be kind of a heavy lift, John, frankly, if it all gets bundled together. Assuming there is eventually a Speaker of the House, they are going to have a very difficult job trying to get members of the Republican Party to allow Ukraine funding to be passed. There is a wide swath of Republicans that are not supportive of that funding. Even if there is bipartisan support for Israel, tying those two things together may make it much more difficult to get it across the finish line.
Just getting a headline across the Bloomberg terminal, the president is saying the Pentagon has showed evidence that Israel did not hit the hospital. That headline just crossing the Bloomberg terminal. The president says the Pentagon showed evidence that Israel did not hit the hospital. Ollie Krug, your reaction to that key headline crossing just moments ago.
So this is what we've been hearing from the Israelis since the beginning. Benjamin Netanyahu saying that planes were not targeting that hospital. And then overnight, we've been hearing from the Israel Defense Forces, and they've been putting out what they say is evidence, video evidence of a rocket taking off, sort of exploding once in the air, and then an explosion on the ground. And then again, they've also put out some voice recordings that they intercepted that they say are members within Gaza confirming this fact. Again, this is information that the Israeli Defense Force has put out themselves. They've put it out as evidence. And if the Pentagon is now verifying that, then that is obviously a meaningful step in really the defining moment of the last 24 hours.
Ollie, this was supposed to be a two-part trip. One part Israel, second part Jordan. And as we know, the President of the United States was supposedly meant to meet with King Abdullah of Jordan, Abbas of the Palestinian Authority, and al-Sisi of Egypt. It was cancelled. Ollie, what is the current relationship like between the President and those individuals currently? And is there a chance that perhaps that summit could reconvene following a headline like that one?
Listen, I think, John, that it's certainly possible. I think that there have been certainly efforts on their part to try to make this sort of thing work. And the problem has been that when you see these things and with inflamed tempers such as they are, it's not necessarily always up to the leaders. It's often up to what's happening on the ground, to the protests, to the people who take to the streets who perhaps will not accept that sort of thing. If those temperatures sort of cool, we've also heard about a potential summit in Egypt that could take place a little bit later in the week. That might be a venue for these sorts of discussions to continue. But really, these are the discussions that are absolutely key if there's going to be meaningful progress in these discussions, and if there's going to be any kind of de-escalation and cooling of temperatures.
Ollie, thank you, sir. Great to catch up as always. Ollie Krug and Katie Lyons. The blame game all night following a blast at a hospital in Gaza, reportedly with hundreds killed. Still need to clarify much of the information on the ground in Gaza, which is tremendously difficult to do. As we know, Hamas has been blaming Israel. What we understand from the United States and the President, Joe Biden, saying the Pentagon showed evidence Israel did not hit that hospital. The latest from the President of the United States. For this market, equities right now on the S&P 500, negative 0.4%. In the bond market, we've seen some big moves, particularly at the long end and including the front end in yesterday's session. The latest news on the request from the Biden administration are reporting suggesting this. The President considering a supplemental request of approximately $100 billion for defense assistance for both Israel and Ukraine. Let's continue this conversation on fixed income with AB's Gershon Distenfeld, Mike Schumacher of Wells Fargo. Gents, great to catch up with you under very difficult circumstances at the moment, given what's happening in the rest of the world. Mike, if we can focus on treasuries. Mike, can this government afford things like that, given what's been taking place in this bond market over the last few months?
Normally, John, I would say $100 billion plus or minus is not that big a deal in Washington. However, and it's a big however, investors have been spooked by Treasury supply. This really came to light a couple months ago with the refunding announcement August 1st. Treasury increased issuance more quickly than people expected, faster than we thought at Wells Fargo. Next announcement's coming up November 1st. That's going to cause some jitters. So I think if the Biden administration requests a very large appropriation, yes, it matters, and I think it's going to cause some ructions on the back end of the curve.
Mike Schumacher, what on earth is going on at the long end of this bond market over the last few months, Mike? Is it just that? Is it just the budget deficit, or is it the data? Is it the Federal Reserve? Mike, what is it?
All the above, John, and frankly, we've been long and wrong, so it's been painful for us too. We've talked to client after client, and you see a number of concerns come to the surface. We just talked about supply, that's number one. Also, the tenor of the comments from the Fed is, I'd say, shifted, become more hawkish. That was certainly evident to us back on September 20th at the last FOMC. Pretty surprising, I thought. Bank of Japan getting a bit more hawkish. Now, it's sort of an odd policy mix out of the BOJ, but I think people are concerned that, hey, not only are Japanese investors collectively not buying a lot of U.S. assets. But you've got the BOJ saying, we're kind of okay if long-term rates go up, so you may want to repatriate more money back into JGBs. All this together has made people a lot less comfortable buying long-term U.S. rates. And as a result, real yields have gone sky high. 240, 250 on the 10-year, about twice where they were at the end of the 2018 cycle. We think it's too much, but it's a buyer strike right now.
Gershon, this bond market has been punishing. You look at the front end yesterday, you get comfortable with the idea that maybe the Fed's done, get a hot data point, retail sales, and all of a sudden you've got to move through 520 on a 2-year cycle high, on a 5-year cycle high. Gershon, can we just sit on the long end a little bit longer? If you look to the UK, I was looking at a gilt, 30-year, matures in 2050, issued back in 2020, trading in the 30s. And Gershon, I was just thinking, have we fully realised the pain associated with the losses in the long bonds in the UK, in the US and elsewhere?
It's possible, John, that we haven't. Yeah, I agree with Mike. It's overdone. The fundamentals don't support yields at this level. But I think what's going on is a little bit simpler. Is most of the past 12, 18 months, the market has really just not believed that the Fed was going to get this high, that they were going to stay this high for that long. And the market, and what's happened as a result is, yields were kind of stuck quite a bit below where Fed funds were. Now, history would suggest that when that the 10-year actually gets to around the level of the overnight rate, when the market believes that that's going to be the case, that's what's happening right now. It's as simple as that. But eventually, rates are going to come down. Now, it might not happen immediately. History would also suggest that you don't start to see a real rally at the long end of the curve until the Fed actually starts cutting rates.
Gershon, you've spoke constructively about credit fundamentals for a while now, given what's taken place since the pandemic. Does the rate shock have the potential to develop into credit issues?
I think it most certainly does. I think we do have to be more cautious around it. And that's why we're actually advocating up in credit quality, whether it's within high yield or double Bs or even into investment grade. This is the higher rates are going to make companies less profitable, earnings more volatile, and perhaps should elevate defaults. That being said, as I've talked about many times, this market is of higher quality and the starting point does matter. But, all in yields now are what people are starting to pay attention to. You look at spreads, they're about average. But all-in yields are pretty high, and particularly institutions as opposed to the retail investor. Institutions for a long time, they had to stretch to buy alternatives in private credit in order to meet their return hurdles. Let's not forget, a couple of years ago, high-yield yields were 4%. Now, with high-yield yields being above 9%, and also other areas, emerging markets, securitized, where you can get high yields, investors can just go for run-of-the-mill type investments as opposed to going out into the alternative space. And that's going to be supportive, we think, of levels from a technical perspective.
Such a big change where we are compared to where we were 10 years ago. Gershon, thank you, sir. Gershon Distenfeld, Mike Schumacher sticking with us. The broader market right now going into the opening bell, 17 minutes away. We're negative by about 0.5% on the S&P. Let's get you some movers going into that open. Here's Abby.
John, weighing on the averages this morning, some of the laggards here. United Airlines heading to its worst day since March 15th. This on the surface, it doesn't look so bad for the quarter that they just reported, but the outlook, it is below the street on both the Middle East conflict and rising fuel costs. Morgan Stanley, similar story, down 2.9% on the surface. They beat both top and bottom line expectations. But below the surface, that $1.41 in adjusted earnings, well, that's a 7% year over year slide. Their wealth management and iBanking units both down. FIC slumping 11%, those shares off 3%. And then finally, NVIDIA down 2.2%, falling on tighter than expected export rules. The U.S.'s effort to keep chips out of China. The stock still, though, John, up 200% this year, but down 2% today.
Abby, thank you. The latest on the Middle East, the tension on the epicenter of what is happening in the Middle East, the tension potentially boiling over, an explosion in the last 24 hours at a hospital, the blast threatening to tip things over the edge. You've heard the blame game. Hamas is blaming Israel, Israel blaming the other side. The latest from the President of the United States in the last 10, 15 minutes. The President says his Defense Department showed him evidence Israel did not hit that hospital. The latest there from the President of the United States. Coming up on this program, Chairman Powell taking center stage before the Fed goes dark.
Frankly, the Fed has won the battle with the American consumer, and they're slowing down. And then the question is, what happens next?
That conversation up next.
frankly, the Fed has won the battle with the American consumer, and they're slowing down. And then the question is, what happens next? I can't predict, but this is a $4 trillion base, $300 to $400 billion a month. So think about it. It's hard to move around a lot. So once it slows this level, it's probably not going to kick right back up.
Bank of America CEO Brian Moynihan weighing in on the Fed. Policymakers out in force, getting their final word in before the quiet period, with all eyes on Chairman Powell. Speaking from the New York Economic Club tomorrow at noon Eastern with David Westin. Richmond Fed President Tom Barkin making the case for patience, saying this: "I'm still looking to be convinced that demand is settling. We have time to see if we've done enough or whether there's more work to do." Mike McKee has more. Morning, Mike.
Morning, John. If Brian Moynihan describes this as a slowing economy, I'd hate to see what he thinks is a rapidly expanding one. Latest data this morning are not particularly decisive for the Fed. Mixed news in the housing market as housing starts rose by 7% during the month, but building permits fell 4.4%. So nothing really telling us where we're going from there. But here's the problem, and this is why we're putting it on Jay Powell's shoulders, is at their September meeting, Fed officials, 12 of them, said that they thought we would have another rate increase, at least one, by the end of the year. Since that meeting, 12 of them, maybe not the same ones, but 12 of them have said, no, maybe we might just pause and not raise rates. Well, the problem is they could do that, but what's the justification? When you look at what we have been seeing in the economy, we have very strong jobs numbers, very strong retail sales. Yesterday we had strong industrial production, and we have a sign of some inflationary pressures rising again. So that doesn't look like a picture of a Fed that's going to pause if they're trying to fight inflation. So that leaves us with Jay Powell tomorrow, maybe the definitive word. The Fed goes into blackout on Saturday, so he'll be pretty much the last word, and we'll see if he gives us any real guidance on what they're going to do for November 1st or December 13th, and whether that last rate move is still on the table.
Mike McKee, thank you, sir. Mike Schumacher, what are you looking for from the Fed and Chairman Powell tomorrow?
I think he'll be fairly hawkish, John, but probably not quite as strident as he was on Sep 20. And I think the rationale for dialing it down just a touch is the huge backup in long-term yields. The Fed can point to that, Powell can point to that move and say, hey, look, the back end's doing a lot of work for us. We don't need to raise Fed funds as much. A number of his colleagues have said things like that. I think that's the argument he can make, and it's a legitimate one.
Does that change the nature of the tightening, Gershon, if you put the emphasis on the long bond and long rates and shift the emphasis away from short-term rates?
Yeah, I think there's way too much focus on whether the Fed's going to go on another 25 basis points or not. That's a rounding error. It's the cumulative effect of all the tightening they've done already. And as Mike just mentioned, the long end of the curve has done a lot of the work for the Fed. So I know the markets will care. I care a lot less about whether they hike or not in November or December. What's really important is what's policy going to be 9 months from now. See, if we go back 9 months ago, remember, the market was pricing in rate cuts. They thought by now the Fed was going to be cutting. That's part of the reason why long-term yields are much lower. The markets now realize that's not happening. Rates are going to be high for a while, and that's why you've seen the long end come up. The question now is what's the data going to be in 6 to 9 months? We're really only just starting to see the cumulative effect. We know Fed policy acts with a lag. How much do we weaken over time? The data right now is very inclusive. That's going to be the key question as we go along. That's going to determine the path of rates over the next 6 to 12 months, not whether they end up hiking another time or not.
So given what we heard from Tom Barkin of the Richmond Fed, and I'll share that quote again, Gershon, I'm still looking to be convinced that demand is settling, but ultimately, this line here, we have time to see if we've done enough or whether there's more work to do. Is that the optimal approach to this, Gershon? If you're at the Fed right now, just wait it out.
Yeah, I don't know what it means in terms of whether they should hike another time or not, but I do think they have to look at the data. We're only starting to see it now, and it is inconclusive. One of the things that we look at very carefully is the kind of the relationship between ISM and 10-year treasuries. And it's never been more disconnected than it has been now, meaning that yields should be a lot lower or things should be a lot better. And our guess is yields are going to end up going lower over time, but the Fed should look at what's going on. The problem the Fed always has, it's not a new problem, is that actions they take today do not necessarily affect the data tomorrow. In fact, most of the time they don't. They affect things out 6, 12, 18 months from now. So it's going to be difficult sailing for the Fed. And that's why I think you're going to see a lot more dispersion among the Fed governors as to where we should go from here.
Gershon, this is important. You're framing there the ISM compared to the 10-year Treasury yield. Let's frame it a different way. Let's compare the soft data to the hard data. You ask consumers how they feel right now. Not great. You look at what they're doing. Retail sales, they're still spending. How wide is that gap?
Well, there is some evidence that kind of the savings that have accumulated over the past few years is being depleted. But, the gap is still wide. And that's why we're going to continue to get volatility. There's really no direction here. You've seen, every number that comes out, it's not like they're all pointing in the same direction. So one thing we should expect, we can argue about where rates are going to be 6, 9 months from now. One thing I think we can almost be certain of is there's going to be a lot more volatility as the market tends to overreact to each and every piece of data, whether it's on inflation or growth or war in the Middle East or whatever it is. We're going to continue to see that volatility.
Mike, do we need to get comfortable with bigger moves at the long end?
We do. I think that's the big takeaway from this discussion this morning, John. Whether it's my comments, Gershon, or President Biden, they all point to markets being exceedingly choppy. And in fact, if you look at interest rate volatility, it's climbed a lot over the last month, as you would expect. It's back to about where it began this year. I think it remains quite high, at least for the midpoint of next year, perhaps farther, as the Middle East sorts itself out, perhaps. We get a lot more clarity on the Fed, the ECB, other central banks. It's going to be a rough ride, so buckle up.
Thank you, gents. Appreciate it as always. Two of the best. Mike Schumacher there, a Gershon Distenfeld. Mike Schumacher, a bruised and battered bond bull, but still sound bullish on what's happening in treasuries. It has been tremendously difficult in this treasury market over the last couple of months. Coming up on this programme, the morning calls, and later, Morgan Stanley closing out big bank earnings with a miss. That conversation still ahead with Nadia Lovell of UBS. Morgan Stanley down about 3%. Your equity market negative 0.4%. Your cash open 7 minutes away. About 5 minutes away from the opening bout. Equities a little bit softer on the S&P 500, negative here by about 0.5%. A bruising couple of days in the bond market, yields higher. This equity market pretty stable in the face of that. We'll talk about that around the opening bout. That's the price action. Let's get you some morning calls. First up, Raymond James upgrading Brinker International to a strong buy, seeing an attractive risk reward following the stock's recent underperformance. Bank of America downgrading Sherwin-Williams to underperform, pointing to weakening trends in the housing market. And finally, Morgan Stanley cutting its Nvidia price target down to 600, saying the latest US export controls appear more draconian than they had expected. That stock is down 2.9%. Coming up, Morgan Stanley closing out big bank earnings with a miss. That conversation up next with Nadia Lovell of UBS. Your opening bell just around the corner. 25 seconds away from the opening bow this morning. Good morning to you. On the equity market right now, negative 0.4% on the S&P 500. The previous 2 days, Monday, decent day of gains. Tuesday, totally unchanged in the face of some monster moves in this bond market. There's your opening bell. Let's get to that bond market. Yields look like this morning on a 10-year, higher again by 4 basis points. Over the previous 2 days, up by more than 20. 486.66 on a 10-year yield this morning. With that, yields up, dollar stronger, euro weaker, 105.53 on that currency pair. We're negative there by 0.2%. And crude higher, rallying off the back of that tension in the Middle East, back towards 90. Let's call it 88 this morning at 87.98, up by 1.5%. About 20 seconds into the session, we're negative here by 0.4% on the S&P. The underperformance again in the Nasdaq, down about 0.7%. What stock to watch at the open? Morgan Stanley. Its wealth management division missing estimates. CEO James Gorman remaining optimistic, saying this: while the market environment remained mixed this quarter, the firm delivered solid results, positioning us for continued growth and strong shareholder returns. Shanali Basak has more. Hey, Shanali.
John, when you look at Morgan Stanley, you're looking at an investment banking environment that is still muted. You're looking at analysts and James Gorman agreeing here that if you're looking for green shoots, you're probably still looking. They are searching for those green shoots. And in the meantime, there's this idea that wealth management, while strong and while still raking in billions of dollars and the ballast to the storm here, you still have wealth management coming in a little bit below estimates. Now, James Gorman makes the point here that if you're making 4 or 5% sitting in cash, you're not going to be sitting there trading in the markets. There's a lot of uncertainty out there. He is just another banker in the line of bankers that is making the point here that there is still caution in the environment meaningfully. Now, with that said, Morgan Stanley is turning to the future. They are looking to invest in international expansion. They are looking to their next deal, even potentially in the next couple of years. And so remember, this is a stock here, John, that has been among the most expensive of the big six banks. You are looking at a stock that was trading at almost 1.5 times book value. And now it's just taking a little bit of steam off of that stock, but still down more than 5%. A big turnaround from the prior quarter with the humongous beat.
We've had so much to talk about in banking, Stanley. I've almost forgotten. Have they announced the new CEO?
No,
Morgan Stanley.
They have not. There was a very subtle hint that if you really watch Morgan Stanley closely, he made a little shout out there to Ted Pick and his work in Japan lately. Ted Pick has been long the contender, running the institutional business, but the fact that they have not named a new CEO yet is making people antsy. And you certainly heard that on the call, people pushing James Gorman to say, when is that announcement going to come? And he pretty much says it can't come soon enough.
We're still waiting. Stanley, thank you. That stock is lower. Difficult morning for Morgan Stanley. A miss. We're down 5% to about 76 in early trading, about 2 or 3 minutes into the session. Let's turn to the airlines. United reporting a disappointing Q4 outlook as the carrier faces pressure from suspended flights to Tel Aviv and higher fuel prices too. The CEO saying this: we persevered through an unprecedented series of events. We're focused on the important changes we can make to serve our customers even better. Abby has more. Hey, Abby.
Hey, John. And on this, we do have the stock at session lows right now, down 7%. Its worst day since July 21st of last year, of 2022. And this, of course, having to do with the outlook. The quarter itself, the third quarter, was not so bad. In fact, some analysts are characterizing it as a good quarter. Citi saying that it was pretty solid and they had good third quarter momentum. But the adjusted earnings outlook for the fourth quarter, if the flights are suspended to Tel Aviv until October 31st, at the end of this month, they're expecting $1.81. If until the end of the year, $1.50. So it's that disappointing outlook beneath the street, plus rising fuel costs, really weighing on this stock. In addition, there is the possibility that travelers could become a little bit more jittery around travel, given the fact that over the last 24 hours, there were 8 airports between France and Belgium that were closed. Now, Evercore is saying that if the effects of the Middle East conflict were excluded, the outlook is actually modestly ahead. The fuel guidance may prove conservative, suggesting that perhaps they have some wiggle room for this fourth quarter. Very volatile year, though, John, for this stock. At the July peak, up 58%, now down about 40% from there, and I believe on the year about flat, maybe slightly down on today's decline.
Just brutal, down by more than 30% from that July peak. Abby, I was looking at the same chart as you were speaking. We were talking about that boom in discretionary spend going into the summer. Arguably, we had that boom. That stock peaked in July. It's rolled over aggressively ever since, particularly off the back of the fuel story, but also maybe flagging some softer demand domestically across a range of airlines in the United States. That's the latest on United. We're down by 6.4%. Abby, thank you. Let's turn to the chips. Nvidia extended its losses after warning that new US curbs could hinder the development of future products. Ed on top of this one. Morning, Ed.
Yeah, good morning, Jonathan. Nvidia down almost 2% in Wednesday morning's session. It had the biggest drop since early August on Tuesday. On a 2-day basis, we are headed for the biggest 2-day drop since December. This is serious, and investors are reacting strongly to expanded US curbs of technology exports to China. Overnight, Nvidia issued an 8K, which in the first instance reiterated what they said in the statement to me. This will not have an impact on near-term financials. But they added to their commentary saying that what this will do in the context of A800 and H800, the China-specific chips that it exports, is actually impact the company's ability to complete development of products in a timely manner, generally speaking. It's also warning that its support for existing customers and those products that are covered, are allowed under the sanctions or under the curbs, will also be impacted. This is a company, Nvidia, that historically takes 20 to 25% of its sales in the data center context from China. You have a number of analysts coming out and reacting strongly to this. Morgan Stanley cutting its price target on the stock, calling these draconian curbs by the United States. Wells Fargo talk about something that you and I discussed 24 hours ago, that the reason NVIDIA is kind of sanguine about this situation is that if they cannot export high-end GPUs to China, there's plenty of demand elsewhere, and lead times right now for data center GPUs are at 35 weeks plus. That's how supply constrained they are. The other way of looking at it is the long-term addressable market, and Bernstein in a note says, look, China's a real concern right now, which kind of echoes NVIDIA's argument that they believe the US in this strategy is blocking one of its biggest US technology companies from accessing the world's most important market, which is China. Real quick, over in Europe, ASML is currently down 4%. It had earnings. Remember, ASML is caught by these sanctions in its ability to export chip-making equipment to China. What's happened basically is China is now 50% of its business, and on the call the ASML CEO is saying, based on the actions of the last 24 hours, only 10 to 15% of that business will be impacted based on what they can and cannot export to China. John.
Ed, thanks for the update. The stock is lower. We're down by about 2% in early trading. Let's turn back to the earnings. Procter Gamble reporting sales and profit that surpassed estimates as higher prices outweighed lower volume. The CFO saying this: the consumer continues to be remarkably resilient and chooses P&G brands. We're growing volume share in the US. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, this is a story all about pricing power. You had global shipment volume drop about 7%, or rather 1%. Prices rather increased 7%. You add that together, it works out to a beat on both sales and profit. Specifically, first quarter organic revenue rose 7% versus estimates of about 5.8%. And the company's on track to meet the higher end of its guidance. So inflation is real. Prices are still rising. But remember what Procter Gamble sells here. We're talking about Tide detergent, Pampers diapers, Crest toothpaste, just to name a few. And within that portfolio, the CFO also said, quote, we do not see a broad trade down. So clearly consumers still willing to spend up on their staples. That's boosting shares about 3% higher this morning.
Hey, Katie, thank you. Just the latest on the ground over in Israel. We have been waiting, looking for an update from the President of the United States alongside the Israeli Prime Minister Benjamin Netanyahu. I've got no idea when that happens. When it does happen, we'll do our best to bring them to you. Those comments from the ground down in Tel Aviv, in downtown Tel Aviv, where the president is residing through much of today. Those comments still ahead. From New York, looking at this broader market, about 9 minutes into the session, we are negative by 0.5% on the S&P. Nadia Lovell weighing in on the Fed's next move, saying this: our core view is high for longer, not higher for longer. We think the Fed is done hiking, and tighter financial conditions are doing some of the work. Nadia, I'm pleased to say, joins us right now. Nadia, let's go straight to the bond market move yesterday and Monday. Yields up again. And this equity market is taking it really quite well. Now, I know it's early days, it's 2 days. We're down this morning by about 0.5%. But Nadia, what did you make of the early price action this week so far?
Yeah, I think you make a good point that equity has been resilient despite the headwind from higher bond yields. And I think it speaks to the why. I mean, bond yields are moving higher because economic growth and the consumer is coming in stronger than expected. And at the end of the day, that should be an incremental positive for corporate earnings. And we think that you're going to start to see that this earnings season, the recovery is underway. And we think that earnings will inflect this quarter. I mean, it's early in the season, but you're already seeing companies in the aggregate beating expectations. And we think that that's going to continue. I mean, in fact, what we're looking for the third quarter, John, is, 3 to 4% earnings growth versus the consensus at about 0%. And so we think that will help the equity markets to continue to pull away from what's happening in the bond market. At the end of the day, we are constructive on equities. When you look at it, the economy is growing, earnings is improving, the Fed is likely done hiking at the very least, and all of those are positive for the equity markets. And so we think that the more economically sensitive areas of the market and the value areas of the market could really catch a bid in coming months.
So preferred sectors, energy. I was looking at the crude call. Nadia, we've talked about this before. You guys still expecting $90 to $100 over the next few months on crude. That helps the energy story. Nadia, what does it hurt?
Of course, we're all watching, inflation, just given the implication for monetary policy. But as you said, we don't expect oil prices to move above $100 in any sort of a sustainable way we think that it's going to stay in this sort of the sweet spot of $90 to $100. But again, continue to watch it. We've heard it from the airlines, putting some pressure there. And so those are areas that we have been avoided anyway. We continue to like the energy story, and we think that also energy and oil does serve as a good hedge to heightened geopolitical risks as well.
So preferred sectors, I've got energy, industrials and staples. Least preferred, real estate, utilities. Now, Nadia, this bond market has beaten up utilities big time. At times it's been selling off. Nadia, you think the Fed is done. Why still underweight, or at least preferred, that sector, utilities?
Because while we think that the Fed is done, we do think that rates probably stay a bit elevated for longer. Remember, a lot of these sectors, utilities and real estate, has really served as bond proxies over the last few years when we were in this lower yielding environment. And now with cash over 5%, they're less attractive. So we're not avoiding the defensive sectors. As you noted, we do have a most preferred on staples. And as you note, Katie noted earlier, pricing power is important as to why we prefer staples to be our defensive play and our sort of our yield play. Companies are still benefiting from price increases that they've passed through. Inflation is moderated, and so cost is coming out with PPI coming out faster than CPI, and so that should really help margins within some of these sectors. And so not completely avoiding the defensive play, just we think that there are better opportunities in staples versus like utilities and real estate.
Nadia, let's finish on the financials. Morgan Stanley's lower in early trading by 5%. I know you can't do single names, so just broadly what we've seen so far this morning, wealth management disappointing, the stock lower. What's the big takeaway, Nadia, for you so far from the financial sector, and what's your call on banks?
Earnings so far has been mixed, but I would say in general, when you look at the banks, they are beating on the EPS on the bottom line. Some companies, of course, exceptions. We did upgrade recently banks and financials to our neutral after being underweight for much of the year, because we do think that a lot of negative news is already priced into place, and the risk is a lot more balanced. I would say what we did hear through the earnings season, which is quite encouraging, is that there is a stabilization in the deposit base, and then for some banks, it's actually even now starting to grow. And if next year you don't see as much rate cuts as the forward curve is pricing in, there could be some upside to net interest income, particularly as assets gets repriced and securities gets repriced higher. But you sort of need to see a stabilization in bond yields first, and a clear signal that the Fed is done hiking to really alleviate some of these concerns around higher deposit costs and those higher unrealized costs, unrealized losses in health and security portfolios. The banks are sort of in a tough place, but Jonathan, a lot of these banks have already provisioned for a recessionary environment. They're looking for unemployment rate to spike to 6%. So while we're neutral, we do still continue to prefer within that space the highly capitalized large cap money centers.
Nadia, thank you. Nadia Lovell, the update there from UBS. Appreciate it. About 14 minutes into the session, we're negative by about 0.5%. Coming up, big tech earnings kicking off with Tesla and Netflix after the close.
Tesla's the innovator. Others are bearing the fruit of this labor. Will investors actually give real time to Dojo and dancing robots and level 5 autonomy when the evidence is pretty heavily stacked against this stuff?
Team coverage up next.
Tesla's the innovator. Others are bearing the fruit of this labor. Single-handedly changed the future of the automotive industry. And, that's where investor focus is and will remain. The bigger questions, though, for the valuation of stock, though, really end up being, price cuts, how much, and will investors actually give real time to Dojo and dancing robots and level 5 autonomy when the evidence is pretty heavily stacked against this stuff?
Craig Irwin of Roth Capital weighing in on Tesla, kicking off tech earnings with Netflix after the closing bell. Investors watching for the impact of Tesla's price cuts and Netflix's looming price hikes. We'll get to our team coverage right now. Ed Ludlow in San Francisco, Geetha Raghunathan in New Jersey. Geetha, what are you looking for a little bit later?
Yeah, so Jonathan, good morning. So going into this quarter for Netflix, actually expectations are a little bit tempered. So actually, if we look at the stock price action from the last quarter when they reported, the stock is down almost 25%. And what we're seeing is that some of the initiatives that they have kind of launched over the past year or so, which is one is advertising, has not really kind of taken off in the way that they wanted it to. Password sharing crackdown, yes, it's been a success, but it's been a little bit of a double-edged sword because yes, it has reignited subscriber growth, which is good, but no, it has not kind of prompted the upside in revenue growth. And so we're seeing a lot of pressure on ARPU, or average revenue per member, and that's not necessarily good. So, of course, expectations kind of really being dialed back as we kind of head into this quarter.
Geetha, last quarter, all you and I were talking about was the strike, the writers' strike, and what would happen to content and the content pipeline. Geetha, has that disrupted the company at all, looking out to next year?
Well, so one of the strikes is over, the writer strike, which is good, but the actor strike is still not over, which again, it really makes the content slate really shaky going into 2024. We obviously know that a lot of the hit series coming out of Netflix, for example, Stranger Things, plenty of others are actually going to be delayed. Having said that, though, I would like to point out that licensed content has actually done really well on Netflix. Think of USA Network's Suits, which has kind of become this phenomenon on Netflix. I mean, this was available on USA Network years ago. This was available on Peacock. But just the ability of Netflix to kind of take an old show like that, a show that is not even made by them, still dominate the pop culture, just tells us the power of the platform and kind of indicates to us that they could go ahead and license a lot more content if their rivals are willing to sell it to them.
The stock has had a decent year. The year to date up by a little more than 19%. Ed Ludlow, Tesla has had more than a decent year. The stock is up by more than 100%. What are you looking for?
Yeah, it's an incredible stock story because you're right, the stock's doubled so far in 2023, and yet at the same time, since December 31st of last year, profit estimates have come down 50%. And the story has been really clear. Tesla has used the lever of price cuts to continue to grow volume sales or units. The question for the street is how much does that impact the bottom line? But you and I have said time and time again, the Elon Musk thesis is they're willing to sacrifice the bottom line in order to maintain 50% annual growth. And they're okay with that. They're comfortable with that. It depends as an investor how much you care about the fundamentals. It was a great summary from Craig Owen just there. There are sort of the value add things like Dojo, progress in artificial intelligence, and also I guess some data around Cybertruck. But then again, there's the valuation question. If profit estimates have come down, look then to automotive gross margin. The forecast is for it to fall to 19% from 28%. At 28%, you talk about Tesla as a tech company. When you're going down towards 19%, the conversation changes. Is this a car company or not?
And it was talking to Geetha about strikes. Writer strikes, actor strikes. Let's talk about strikes in the auto sector. You'd have to imagine the executives at Tesla are just sitting there rubbing their hands together as this plays out in Detroit.
Yeah, I mean, the read-through that I hear from a lot of investors as it relates to Tesla is simply on availability, right? You know, think about the General Motors news of 24 hours ago, the delay to launching a second factory in Michigan for electric trucks. There's kind of continuity in planning on the OEM side for Ford, GM and Stellantis, and the availability of the limited number of battery electric models that they have. Tesla's available right now, and they're kind of spared from this story. So there's a brand awareness issue, but there's also just a supply issue, which some think that they'll benefit from. And it will be interesting to see if Elon Musk can resist the temptation or not, John, to talk about the ongoing strikes during Tesla's earnings call.
So true. Something to listen out for a little bit later. Ed, thank you. Geetha, to you as well. Ed Ludlow, Geetha Raghunathan. Let's get you some sector price action. Around the open, about 23 minutes into the session now, we're positive, or rather negative by 0.5% on the S&P with some sector price action. Here's Abby.
And that's the worst day in almost a week, John, surprisingly enough, given all of the volatility that we've had. And it's reflecting sector-wise. More sectors for the S&P 500 are lower. Industrials down the most, down 1.7%. Caterpillar, Deere, some of these big names are lower. Materials also down. Real estate down more than 1% to the upside. Energy up about 0.9% as oil does rise back above $90 per barrel. Taking a look at the sectors on the month, though, the best sector on the month right now is that telecom sector. And you guys were just talking about Netflix. Well, Netflix, of course, reporting after the bell, and it's a piece of the action. Although Netflix, quite frankly, John, this month has been down. It's going to be interesting to see how that report comes out after the bell.
Abby, thank you. Your trading diary up next. Equities lower by 0.4%. No real drama here. Let's get to the day ahead. It looks like this. President Biden speaking any moment from Israel. House Republicans expected to hold a second vote for the leadership, the speakership, at 11 a.m. Eastern Time. Netflix and Tesla report results after the closing bell Thursday. Fed Chair Jay Powell headlines a week full of Fed officials before the quiet period, plus more earnings from regional banks, including Fifth Third and Truist. Friday, American Express and Regions reports earnings. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.